Hello and welcome to today's Premium Account Market Update for October 2015. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hein, Managing Director of Investor Signals, have 17 years of experience in the financial services industry and a current licensed securities and derivatives advisor. The format for today's presentation, we look at a quick macro update driving equities. We roll through the ASX top 50 with a particular focus on FES 16 earnings forecasts. For a change in today's recording, we tie in the technical trends versus fundamental data and really just comparing what the charts are telling us versus that of earnings forecasts and in general global economic growth. We try to tie that in with a summary of the portfolio allocation and the short-term market outlook. The Investor Signals Premium Account Service is a model portfolio of ASX top 50 stocks who utilise call options to enhance portfolio returns focused around effective ownership around ex-dividend dates, trying to generate above average cash flow from call premium and option while still providing for some capital growth. It's a strict investment mandate, therefore suitable for self-managed super funds, and importantly the assets remain in your name. If you'd like to discuss it further with me, please contact me, Leon at investorsignals.com. Moving straight into an index of the ASX 50. And I really just focus here a little bit initially on the technical picture that we're seeing in the market. Now, the fact that the market's breaking down and creating a lower low from this recent structure here sees us back on price levels that we've been trading at, effectively back in 2013. The market now pushes back up to a 5% dividend yield after at some stages compressing down to low fours. Forward PE ratios are running at around 14-15 times earnings. International companies in the industrial sector still deliver some reasonable levels of growth supported by lower Australian FX rates. Domestic companies within certain sectors, which we'll focus on, again, still delivering okay growth rate. But as a general rule, global economic growth probably likely to trend at around 3 to 3.5%. Australian GDP at around 2.5%. It's a difficult environment for companies to be growing earnings. So we're seeing in the 2015 earnings season, the general theme was pretty anemic revenue growth. Cost cutting, was a driver of profit, and to a lesser extent, but certainly some share buybacks here in Australia. That's certainly more prominent in the US, with almost half of US S&P 500 earnings coming from share buybacks at present. On a forward basis, if the US can deliver earnings growth somewhere between 4 to 6% over the next 12 months, I think that'll be an acceptable outcome. And for the Australian market, looking for numbers something similar to that. All right, on that note, let's move into the top 50 stocks and focus on which companies are likely to deliver earnings growth and how we're structuring portfolio allocations in light of that. AGL, so continue to like AGL simply from a defensive earnings standpoint, should deliver about 8 to 10% earnings growth, but most importantly, the company's increasing its dividend payout ratio, so shareholders should be rewarded either through return of capital or through increased dividend payments over the next year to 2 years. That should see that the current yield of 4.5%, I think, underpins the share price, and potentially we see that yield pushing up to about 5.5% over the next 12-18 months. So with that in mind, any sort of pullback to around $15.50, I think is good value there for AGL. Amcor, this is still a favourite for portfolios, although it's underperformed a little over the last month or two, just I think really probably more than anything in line with emerging markets, this theme that as the US has to raise interest rates, emerging markets begin to suffer. It's being compounded by the obvious slowdown there in China as well, having a knock-on effect to emerging markets. We've seen Amcor expand aggressively over the last couple of years with bolt-on acquisitions in the emerging markets. So I think the market's unwilling to kind of continue to pay a premium for Amcor. So where it sits at the moment is a 4.5% dividend yield, trading on a PE of around 17 times earnings on 2016 numbers. Again, should grow earnings maybe around 6 to 8%. I think the strategy is it's still okay to own it here, but you want to be fairly aggressive with selling the covered call over Amcor and boosting those cash flows from the dividend and the call option. AMP, look, it delivered a good earnings result, AMP, so it probably needs to be given the benefit of the doubt. But again, I'll just point as I roll through these, the amount of charts that we have this negative technical structure occurring in. And for that reason, sort of my way of thinking at the moment is really trying to identify companies that have low volatility, where we can buy in at or near these levels, sell covered calls, collect upcoming dividends, try to stagger that around companies that are paying dividend within sort of the utilities and defensive area in property trusts around sort of the latter part of this year, and then setting the call options on the other side of that, and then in the other companies that are paying dividends in the traditional cycle there of sort of February, March, we can come a little bit shorter dated there with the covered calls and drive the cash flow out of that, prior to that sort of February, March dividend. So AMP, just to sort of summarize that before I move on, I think it's fair value here. Trades about 5.5% dividend yield, 14 times earnings. As I said, delivered about 10% earnings growth in FY15, so deserves probably the benefit of the doubt. The banking stocks, the litmus test here for the banking stocks is going to be the S&P 500 companies delivering in the financial sector, delivering their earnings this week between JP Morgan, Wells Fargo, Morgan Stanley. We'll, like Goldman Sachs, we'll really get a read on whether the domestic US banking sector has continued to perform well. And I think there's probably every reason to suspect it probably has. I guess there's a bit of a question mark as to their proprietary trading and the exposure that they've maybe taken in international markets and in the commodity markets. But certainly the US consumer seems to be holding up well, and so does the US housing market. So, one would think that the earnings results coming out of the US banks probably won't be too disappointing. I suspect that probably as we get further into the US earnings season and have a look at, and this is obviously for the September quarter, and we see the multinationals with greater exposure to a higher US dollar and greater exposure to offshore earnings, that's probably the area where we'll see earnings miss. But, again, to be fair, they've been marked down already a fair bit as a result of the sell-off that we've seen over the last month or two. So all things being equal, I expect that the base case is that the market largely moves sideways. The Australian banks, I think, this week, if we do get a better backdrop out of the US earnings season for their financial sector, the Australian banks could push a little bit higher. I'd see that as an opportunity to sell covered calls over them. APA, so this is one of the few stocks that has a reasonably bullish technical structure here. So again, I'll just point this out as I roll through. So this one comes onto the radar, and we continue to watch that in the weeks ahead as a potential area to allocate capital into. ASX, I think the company delivered about 5-6% earnings growth. The stock trades on about a 5% dividend yield, trading about 18 times earnings. I think there's some concern about the capital expenditure that ASX is having to undertake to upgrade their technology systems and stay competitive. Obviously, it's an investment in the future, but whether shareholders get a little distracted, with short term with that additional capital expenditure. But again, my base case is that at these levels, 5% dividend yield, growing earnings on a forward basis, again of maybe 5%, the stock's okay value here. I still think it's got a reasonable chance over the next 12 months of being subject to a takeover announcement. And for that reason, it's worth having some exposure to ASX, I think, in portfolios. AZJ, great cost out story, delivering 10% earnings growth, increasing dividend payout ratio. The stock trades about 16 times earnings on a 5% dividend yield. I think this has got a good bullish structure here in place. Happy owning it, selling covered calls. I think that one makes sense in portfolios again, especially in this environment. BHP, so I spoke last month about the prospect of BHP getting ready to break to the upside. We've started to see the early stages of that. I'll flag the technical structure here that we're getting a sell signal sort of off the back of this bounce, which is not unusual sort of when you get a downtrend and then a sharp rally. My thinking here at the moment is oil looks like it's had a reasonable bounce from its lows, something in the order of 30 to 40%. Iron ore's recovering as well. In all probability, the Shanghai Composite or the Chinese equity market's probably establishing a base or a floor that should underpin commodity prices. I think BHP moves sideways and it's okay as a buy right strategy at the moment. Brambles, so here's an example of international offshore earnings benefiting from a low Aussie dollar. But they have struggled a little bit to contain costs in the US and really to deliver global growth or to deliver earnings growth in Europe, and obviously exposure to emerging markets, slowing global trade and so on is impacting Brambles, and we've seen it pull back from probably trading something in the order of 20 to 21 times earnings up at these levels back down to something in the order of around 17-18%. So during that period, we actually haven't seen earnings fall away. It's just that the forward growth expectations for the company have been ratcheted back. I think we're really back at fair value at the moment. It trades on a 3.7% dividend yield, looking for forecast earnings growth of around 5 to 8%. Again, like Amcor, happy owning it, but need to be selling covered calls to complement the returns out of it. CBA, same story for all these banks. I think we could get a slight push higher off the back of a buoyant sort of result out of the US banking sector. I think, again, to keep that in context, I don't think any results out of this US earnings season are really going to ignite a rally in the market. At best, I think we get sort of some short-term kick higher, but in all probability, the earnings results will just be enough to satisfy the market and see it continue to track sideways. At best, as I've maintained, we don't see a rally out of equities until maybe November, December, or probably more December, January, February, and really that's only going to occur if we start to see better economic data out of Europe, so there's still a question mark over that at present. But CBA at these levels trading at around 13 times earnings on a 5.5% dividend yield, happy owning it. If we do get a little bit of a rally, we'll take advantage of that and sell the covered calls in the days ahead. Coca-Cola, so this is named recovering okay. We've just had the call options wind off last month. We collected roughly 30 cents a premium for those at the 9.25 level. We're just looking now at reselling the calls again, trying to bring in another 30 odd cents from calls out into the early part of the new year. I think Coca-Cola, as the company's highlighted, the losses or the falling earnings trend is hopefully behind them now. We're looking for forecast earnings growth of 5%. That could see earnings in FY 16 of around 52 cents. The company's likely to pay out about 45 cents in dividends. I think it's an okay story, but again, not much in the way of earnings growth and need to be selling the covered call to complement the returns. Computershare, disappointed in earnings results. The company missed earnings guidance by somewhere in the order of 10 to 15%. The market significantly adjusted the valuation here from Computershare from once trading up 17, 18 times earnings down to 13 times earnings. Not much in the way of earnings growth over the next year or two. The stock's on a 3.5% dividend yield. So again, need to sell the covered calls, drive the extra cash flow to justify holding the stock. CSL had been growing earnings 10% or so. Probably over the FY 16, we're only likely to see that number maybe closer to 5 to 8%. Still, I think in this environment, that's okay. The stock's trading on an okay PE of 21 times earnings. Okay, I think this is a name where we've got a reasonable support level, a good technical structure, some reasonable visibility on forward earnings growth. This is a name that's worth owning in portfolios and selling covered calls. Caltex, I think, fits into that category as well. I don't see much in the way of upside growth here for Caltex, but I think it's likely to trade sideways at or near this range. Crown Casino, in the last recording I mentioned that it's getting a little bit oversold and it's due for a technical bounce. The data out of Macau still looks pretty woeful. What we've seen is the Chinese government come out and say that they're going to look at doing more to support the Macau economy, and that was really what turned this the rally, or started the rally there in Crown Resorts. We've seen a really big pickup in wins in the US, with its exposure into Macau, rallied about 30% off its lows. So in percentage terms, Crown hasn't performed anywhere near as well. And it's very difficult to get a read. I think sort of this the earnings trend data out of Macau is, being probably worse than most analysts would have expected. And again, I think in line with probably my view that maybe the Chinese composite is bottoming. The story for Crown is it can probably bump along sideways here, but I don't think we're quite ready for another leg higher in the rally there in Crown. Goodman Group, so we like this name within the property space. Has pulled back a little. It was compressing down a sort of low 3.5% yield. We're now back at around just over 4% dividend yield, but again, best it's at fair value, likely to trade sideways. Our preference has been for GPT, and you can see here the bullish structure that's remained in place here at GPT, trading at about 15 times earnings, just on a 5% dividend yield. We own it at lower levels. We've been selling the $4.70 call, getting anywhere from 15 to 20 odd cents for that, so effectively giving us an exit price back up here at around $4.90. If the stock trades sideways, a combination of that call option and dividend income's generating about 10% cash flow. So happy even if we do end up in an environment where GPT trades sideways. IAG, not much in the way of earnings growth over the next 12 months. I think fair value is $5 support, $5.50 resistance. Any sort of slight uptick in China and emerging markets, I think, underpins IAG a little, as they are investing reasonably heavy in China and other new frontiers. And I think that's where sort of some of this risk adjustment has occurred in the share price. But from an earnings perspective, the company should deliver about 40 cents of earnings per share in FES 16, and that puts the stock on about a 5.5% dividend yield. So I think I could see IAG compressing back down to just below 5% yield, which would put the stock up at 5.50, at which time I think you want to be selling calls over it. IPL, so we've participated in this rally. We owned it at lower levels here. I flagged that we've actually got a negative structure in place here where it's making lower low and lower high. At $4, I think the stock's probably full value short term. I think maybe into the early part of next year, or probably around April, May, we could see announcement out of the company for 2016, 2017, where they're likely to return capital to shareholders upon the completion of the Louisiana plant. At the moment, the stock trades at about 14 times earnings on a 3.5% yield. So I think that caps this recovery. So we own it at lower levels. We sold the 360 covered calls. We got 20 cents for those. So our effective exit price up here is around 380. And I think probably at the end of this month, in the end of November, that'll be about where IPL's sitting. So I've been happy with that trade as a short-term addition to profits in portfolios. James Hardie Group delivering good earnings growth off the back of continuing strength in the US housing sector, trading 21 times earnings on less than a 4% dividend yield. At best, the stock trades sideways at these levels. Lendlease, now the sell-off here surprised me. I thought this stock was okay value at around $14. It's pushed much lower than that. I still think that the company can deliver maybe something close to 10% earnings growth, puts the stock on a 5% dividend yield. So whether we sort of the sell-off goes a little bit deeper, it's hard to know. But I really sort of, if it does, I suspect it's setting itself up for a much stronger bounce in the months ahead. So it's certainly one of those names I'd keep on the radar at the moment. Mirvac Group, these property plays continue to remain relatively weak. We're not doing very Mirvac at the moment. Medibank Private, so very thankful that we had a reasonable exposure to Medibank Private over the last few months. It's one of the few stocks that have outperformed relative to the rest of the market. Medibank delivered a pretty good earnings result. The stock is trading on about 3.5% dividend yield now, so it is getting expensive again. I think anywhere up here around $2.50 to $2.60, it's worth looking at how ways to lock in profit on that trade. Macquarie Group continues to do well, and this was on our radar. I think if we continue to see better data out of Europe, I think it probably becomes a relatively safe buy right at or near these levels, and it is one of the few stocks that has a fairly bullish technical structure still. NAB, so a little bit of the opposite here, negative structure playing out there, but again, in line with my view on the banking stocks in general, if we see better numbers out of the US this week, the domestic banks can push a little bit higher. They probably don't have much more than about 3 to 5% earnings growth in the 12 months ahead. So to take the opportunity to sell covered calls if we do get that rally, I think makes sense. Newcrest Mining, again, just to revisit the technical picture here, the stock is gradually putting in a higher high and higher low, but we're really at the precipice here to determine whether we break into an uptrend. Now, from an earnings standpoint, or break out of this sort of range, I should say, that it's been trading. If we do get a break higher through $14, it'll be breaking through this high, and when we see a retracement back, we'll probably see a lower low structure occur. Now, there's no dividends on offer for Newcrest. I think we're probably 12, 18 months away from the company returning to dividends. They're going to be focused on returning or paying down debt with any proceeds or any profit that the company makes over the next 12 to 18 months. So it really is just a story is, do we think gold can perform over the next 6 months? And really what's caused this rally short term is the Federal Reserve not raising interest rates. If we see any movement from the Fed over the next month or two, gold's probably likely to struggle again. So just a little bit cautious there on how we play Newcrest over the next month or two, and really keeping an eye on those macro trends there. Origin, I think following this capital raising, I think Origin actually looks okay. They start to get their debt sort of down from around 11 billion, still at high levels, probably see it come down to around 9 billion. Obviously, the stronger we see a recovery in oil and gas prices, the better it underpins Origin. But really, probably fair values maybe back up at $8. And again, I think if we see any rally up towards those levels, it's worth looking at selling covered calls to try to drive some extra cash flow there. Oil Search, so it's subject to the takeover offer from Woodside. The Oil Search board's obviously rejected that at the moment. So whether Woodside comes back with a better offer, there's speculation it needs to be somewhere between sort of $8.50 and $9.50. I'm not sure whether Woodside will pay up those type sums. I guess it is a little bit rare to sort of see only one offer come forward. So maybe in the weeks or months ahead we do see a higher price. Whether it gets up to that sort of $9.50 that probably Oil Search board's looking for is another thing. The strategy here with Oil Search, though, is I think because it is subject to a takeover target, because their cost of oil production is so low, and they have a significant amount of production increase coming through over the next 12 to 24 months, underpinning earnings growth even in a low oil environment. Probably out of all the energy stocks, Oil Search makes the sense to own it, and it just then becomes a question, do you sell the covered calls and block yourself out of the potential takeover premium, or do you just satisfied that it's a fairly defensive way to drive higher cash flows out of this market, owning it at these levels and selling calls at around maybe $8.50. QBE, so the good technical structure here, it's one of the few stocks that are putting in sort of a higher low pattern here at the moment. I've got QBE trading about 5.5% dividend yield. Should deliver earnings growth somewhere around 10% over the next 12 months. So I think in that environment, QBE could trade back up to around $14. Ramsay Healthcare, great example of where the market's no longer willing to pay a premium for guaranteed growth. So you've seen sort of the likes of CSL, Ramsay, all contract a little on a PE basis, and I think Ramsay bumps along sideways at or near where it is. Rio, same story as BHP. We're seeing the recovery in iron ore prices sort of drive this recovery off a very oversold level. I think from a dividend yield standpoint, with the cost control measures that Rio putting in place and an iron ore prices at or near where they are, maybe we see earnings somewhere in the order of around $3.50, $3.60, and FY16 puts a stock at about 14 times earnings, trading at about a 6% dividend yield. So again, whilst it could push maybe a little bit higher up to $55 or even $57, I think we're probably in an environment where really these Rio and BHP and even Woodside Petroleum really move sideways until we get into that potential rally period into December through to February. South32 nothing doing there at the moment. SCG within the property space, I think this is reasonably defensive. We're likely to see the company deliver about 5.5% dividend yield, which is off the base of 23 cents of earnings per share. And I think, in the way of earnings growth, you're not going to see much. So it's a situation where SCG trades sideways. If we do own it, we're selling tight covered calls over it to drive that cash flow higher. SEEK disappointed in the earnings season. So we've seen them effectively pass off a $20 million earnings miss as an increase in investment spending over the next 12 months. We've seen the share price drop from sort of $16 down to $12, $13. I think you still just need to be a little bit cautious here. So whilst it's a new entrant to the ASX top 50 stocks, we're watching it closely, but we haven't sort of determined that the earnings stability there's right for SEEK for us to allocate towards that. Stockland, so I'd mentioned here that one of the positives for Stocklands is the company's maintained a fairly flat dividend policy of around 24 cents payout, and we're gradually seeing the earnings per share tick up to around 28 cents. So they're starting to finally build a little bit of a buffer between their payout ratio and their earnings per share. And I think that's a healthy thing for the company. Whether the stock trades down to sort of $3.50 over the next month, off the back of ongoing volatility, I suspect that probably Stockland starts to actually deliver a reasonable opportunity. And these property stocks, whether it be Stockland, Lendlease, are all worth, I think, sort of keeping on the radar over the next 4 to 8 weeks, as they will likely present a reasonable buying opportunity that, when we get into sort of, 6 months down the track, we probably look back and recognise they're a reasonable value. Sonic Healthcare, we've seen this name pull back. Now, we've taken profit on this after owning at lower levels, and we're waiting for this pullback. I've only just started to step back in with some small exposure to Sonic at this level around $18. I think with the company on a 4.5% dividend yield, still likely to grow earnings and maybe close to 10%, paying dividend around 80 odd cents. I still think the stock's attractive. Any pushback up to around $18.50, we take the opportunity to sell the covered calls. Again, I think it sort of trades sideways at or near these levels. Santos, not doing too much here at the moment. Preference is probably to look at Origin over Santos, just given that Origin's already moved on their capital raising and shoring up the balance sheet. It's a little bit of a question mark over what Santos ultimately end up doing to help repair their balance sheet, whether it's a asset sale or a rights issue. We'll just have to wait and see. Suncorp, Bank of Queensland delivered an okay earnings result, slightly better than the market anticipated. I think Suncorp, keeping it in context that 75% of their earnings come from insurance. I think at these levels, Suncorp probably looks okay, 11 times earnings, 7% dividend yield. I think maybe they deliver earnings growth of probably not much more than 5% over the next 12 months. So again, where we do own it, we've been pretty aggressive selling the covered calls, and I think it's sort of best it sort of bumps along at or near where it is, but maybe the downside risks are reasonably well insulated there in Suncorp. Sydney Airports, these infrastructure names and utilities have continued to do very well. Sydney's probably surprised me that it's kicked on as strong as it has, getting down to a low 4% dividend yield. Our preference still probably remains Transurban over Sydney Airport, so we like Transurban. We have been fairly aggressive with selling the covered calls over it. I think this pattern remains, which is really sort of 950 support and maybe 1025 resistance. It's likely to be a little bit stronger off the back of the better traffic data and revenue numbers that came out today, and as we push into the December dividend, where the company will be paying out roughly 21 cents in dividends, in December, Transurban's probably likely to hold up reasonably well into that period. So therefore, any pullback sort of back below $10 is probably an okay opportunity to jump back into Transurban. Telstra, I think on this sell-off starts to look okay. Hard to sort of know where the floor ultimately is, whether it could be sort of 525 or is it 550. But I think at these levels with the stock trading on a dividend yield of about 5.5% on 15 times earnings, I think it's starting to look okay value, especially if we get a little bit of a rally coming into the February dividend, and maybe around December, January, we can take the opportunity to sell a covered call into the middle part of next year and boost that cash flow from sort of that 5% up to 10% through the dividend and the call option. Westpac, as with all the banks, looking for it to just push a little bit higher off the back of better banking numbers coming out of the US, then take the opportunity to sell the covered calls. We're getting anywhere from sort of 70 cents up to maybe $1 for covered calls in Westpac. Combine that with the fact that we'll be collecting the upcoming dividend in November, receiving around 5% cash flow for the next 4 or 5 months through our strategy in owning Westpac and selling the covered call options. Wesfarmers, good underlying business here. Coles and Bunnings growing close to 10%. That puts the stock on about a 5 and a bit % dividend yield, trading about 17 times earnings. They're paying out around $2.10 of dividends per share over the next 12 months. Wesfarmers, if they can deliver ongoing sort of 10% earnings growth, I think there's an argument that the stock can trade back up to sort of $42 to $43. If we see that happen, I think that's a time to get aggressive and sell covered calls. I don't think there's probably the earnings momentum for the stock to push too much above those levels that I'm referring to. And then finally, just to wrap things up, moving into Westfield. So we own this at lower levels. We've been aggressive with selling the covered calls here. We're getting around 20 odd cents for the covered calls. So our effective exit price is around $10 for the stock. That compresses it back down to a sort of a low 3.5% dividend yield. I don't see it doing too much more than that. Earnings growth may be somewhere in the order of 5%, but any pullback in Westfield, I think this is a name that we stay exposed to in portfolios over the next 12 to even 24 months. And really what it's all about now is trying to build a portfolio of these relatively defensive names with Westfield, Transurban, some exposure to the banks and selling fairly tight covered calls over them, trying to pick up some rotation out of names that we've made profit out of, like Incitec, Medibank Private, and maybe look to rotate those funds into some of these property names over the next month or so that start to get a bit beaten up, where value is beginning to present at the moment. But certainly the bulk of portfolio allocations, trying to stick in these defensive names that have reasonably good supportive trends and defensive earnings, solid dividend yields. Woolworths, we're starting to see a little bit of positivity creep in around Woolworths, potential sort of restructuring numbers that analysts are running over the company and making their way into the media. The stock trades at about a 5% dividend yield, about 14 times earnings. They'll pay out about $1.35 of dividends over the next 12 months. The story here is really to see what happens over the next couple of months with their Masters hardware strategy, and ultimately what Lowe's end up doing with the put option that they have, which could end up if their Woolworths is Lowe's exercise and Woolworths is forced to clean that up. It could come at a cost of around $900 odd million to Woolworths on top of what they've already poured into the Masters hardware strategy. So that's probably the area that the market's just got a real concern over, and I think at best maybe there's some early indication that the new format in the Masters hardware store is starting to deliver a little bit better results. But it'll be interesting to see whether Woolworths is sort of committed to the longer term strategy there, and whether shareholders are willing to be patient. I think that we're probably likely to see, if I had to have a guess, I think they probably stay the course with the Masters hardware strategy. I think, with any luck, we see Lowe's hang in there as well. But worst case, Woolworths look at some type of rights issue, clean up the partnership there with Lowe's, and maybe stick at it another 12 or 24 months. In that environment, I think you're probably likely to see Woolworths really trade sort of between $25 and maybe $29, and really bump sideways for a while, in which case it'll give us an opportunity to grind out selling covered calls and trying to sort of bump that cash flow up to around 10% a year. Probably not until the stock trades at around $27 that I look to sort of stretch that out to maybe $29.50 calls, try to get 50 to 70 cents for those into the new year, and combine that with that March dividend, which will give us roughly $1.20 of cash flow over the next 6 months out of Woolworths. The risk with that strategy, obviously, is if we do see the company do something more significant with the restructuring of the Masters business, we could see it pushed, break out to the upside. But even in that environment, I don't see it trading much above sort of $30 to $31. So you're not giving up a whole lot on the upside to participate in what I think is probably the more probable outcome, which is they stay the course with Masters, and as a result, Woolworths sort of bump sideways with around $29 being the resistance. All right, and finally, Woodside Petroleum. In this name here, look, I have the stock trading about a 4.5% dividend yield, trading at about 19 times earnings. It's hard to get a handle on what that means on an earnings per share basis, but in FY16, I think they could deliver a range anywhere from around $1.30 a share up to $1.60 a share. Now, they're forecast to pay out dividends of $1.40, so they're roughly in a range where they're going to be able to cover those dividends from earnings. Obviously, if we get any ongoing uptick or recovery in oil prices, the story starts to look a lot better for Woodside. But my thinking here is any that we're around $34, if we can get calls away at that strike, I think it's worth doing that, especially if we can be getting sort of 50 to 70 cents for those over the months ahead. And finally, back to the index. So just to summarise, I think I covered off on the asset allocation and how we're structuring portfolios. So it's really just a technical summary here, just to keep an eye on what type of pattern plays out in the market. I'm mindful that we've broken down into a lower low. The pressure is to the downside, but it needs to be balanced with a macro view that we're probably starting to see slightly better data come through from Europe. America's delivering okay consumer numbers, okay corporate numbers. We have seen a little bit of a recovery in the oil and commodity space. The housing market in the US continues to do well. China's already gone through a big adjustment, off roughly 40% from its highs. Hopefully the Shanghai Composite stabilizes. If we don't see a push higher in US interest rates, we don't see the strength in the US dollar. That takes a bit of the pressure off emerging markets short term. So my base case is market moves sideways, and maybe we get into an environment where global GDP looks to be accelerating a little around December, January, and maybe the US can raise rates without the market seeing it as a huge negative. But we're still a little way away from that, and therefore portfolio construction needs to be very defensive, and call options need to be utilised, both to provide some protection to the downside through reduced volatility, but more importantly, drive the cash flow to justify taking the risk in holding equities. Thank you for listening in, and if you'd like to know more about the Investor Signal service, please contact me on the details on screen.